we can start. Okay, thanks everybody. Coming back to this monthly webinar. Today we will have a paper on microfinance presented by Jing, Jing or Jing. Hard to Jing. Thank you. And this is a co-author with Adam, and I know that this paper is R&R at AER. So looking forward.
Okay, hi everyone. Thanks to Google for inviting me. So today I'm going to talk about indirect effects of access to finance, and this is a joint work with Adam SZEIDL. So we know lack of credit is widely believed to be a major growth barrier for firms. And in recent years, there has been a surge of policy interest in improving firm financing in developing countries. As we can see in this figure, many governments are providing credit programs to enterprises, especially to small and medium enterprises. And such programs are typically justified by the desire to improve aggregate outcomes. But although there's a growing number of evaluations looking at the impact of such credit programs, most of those studies focuses on estimating the direct effects, estimating like whether borrowers gained from improved access to credit. But such credit programs may also have important indirect effects on peer firms and consumers. For example, the growth of borrowers might at the expense of their competitors, and credit can also affect consumers if borrowed firms manage to improve their product quality and prices. And understanding such indirect effects could be key to measuring broader policy impacts on society. So in this project, we try to fill in this gap by using a randomized field experiment in China, in which we work with a big bank and we randomized access to a new loan product for SMEs, both within and across local markets in China. So the intervention created variation not only in the firm's treatment status, like access to the credit, but also in the share of its peer firms in the local market got treated. So we seek to answer two questions based on this design. First, what are the direct and indirect effects of improved access to credit on firm performance, and what are the mechanisms? And second, what are the implied welfare effects? So we evaluate the welfare gains by combining our estimates with a simple model of industry equilibrium. So this work built on and contribute to two main literature. First, we built on the studies looking at the impact of finance on firm performance. For example, the Mao, McKenzie, and Udrip 2008 paper randomized cash grants to micro enterprises and estimate return to capital. Banerjee and Duvlo 2014 studies a policy change in India and shows that big firms in India are severely credit constrained. There's also a line of research evaluating the impact of microfinance. So what we added in this paper is to also estimate the indirect effect of credit. Second, the paper also relates to some of the recent work looking at some evidence of indirect and general equilibrium effects of various types of firm level intervention. So there's very little work on this except for the following three papers. Bloom, Schenkelman, and Van Reenen 2013 studies the indirect and spillover effects of R&D investments in the US. Rotenberg 2013 estimates indirect effects of a government subsidy program on mid-sized firms in India. And McKenzie and Purto 2021 estimate both direct and indirect effects of business training program on micro enterprises in Kenya. So what we contribute in this paper is to provide randomized experiment evidence on credit's indirect effects on SMEs and also consumers. And we also provide evidence on mechanisms and a model-based welfare evaluation. So next, let me firstly introduce our experimental design. In the year of 2013, a big bank in China introduced a new loan product to SMEs in Jiangxi province, located in southeastern China. The program was targeted to local clusters of firms. So those are like typically retail and service firms located in some specialized local markets. So for example, there are furnitures market where most firms in the market sell furnitures, and also there's building materials market, clothes or shoes market, etc. And the fact that the program is targeted to local markets is the key innovation, and there are several benefits of doing so. So for example, in each market, there is a market office and a market manager who can provide rich information about local firms to the bank. And this can greatly save the screening and monitoring cost for the bank. It may also potentially reduce the time cost for bank officials, because by visiting one market, they can potentially talk with several clients at the same time. And because of those cost reductions, the bank does not require any collateral for the product. And they also try to standardize the application process and make sure that they make a decision in 2 weeks. So those made the loan product very attractive to potential borrowers at that time. And if a firm decided to borrow, they can get a maximum loan equaling to 500,000 RMB, which is about 60,000 US dollars, with a monthly interest of about 0.7%. And they typically pay interest every month and repay the principal after 2 years. So this is a picture of one of our sample markets. This is the market for building materials. So you can see from this photo that this is a market located in a mall, but there are also markets where there's stores on each side of the street. And those markets are already defined by the local government. So our main intervention is to have the loan officer visit treated firms monthly for a year. In each visit, the loan officer would provide information about the loan, remind potential borrowers about the benefits, and also offer to help them to fill out all the complicated application forms if a firm decided to apply. So you can view this intervention as a combination of the information treatment plus a reduction in application cost. So we have a sample of 78 local markets in China, and we firstly randomize those markets into 3 groups. So firstly, we have 31 pure control markets in which we did not offer the intervention to any firms in those markets. Then we have 10 half and half market in which we offer the treatment to 50% of firms in those markets. And lastly, there's also 37 80% treated market in which we select 80% of firms in those markets and then provide the intervention. And in both 50% and 80% treated markets, firms were randomized to receive the treatment. And then we also survey half of the firms in all markets, which gives us a total sample of about 3,100 firms. And we conducted 4 rounds of surveys. So first is a baseline in summer 2013, which is right before the intervention, a midline in summer 2015. So we skipped 1 year in order to allow time for firms to borrow and grow. And also an end line in summer 2016. So in those 3 4-round surveys, we collected rich data on firms like finance information, the borrowing from formal and informal sources, and also operation information. Lastly, we did a short follow-up survey in summer 2020 in order to collect retrospective data on firm location, prices, service quality, and also we randomly selected 1 customer in each store to ask for a survey of customer satisfaction. So next, let's look at some summary statistics. In this table, each row reports results from a separate regression in which we regress each of those variables in column 1 on indicators for the different treatment status, including treated firms in 50% market, untreated in 50% market, treated 80%, and untreated 80%. So the coefficient of the constant reflects the mean average of the variable at baseline for the pure control group, meaning firms in the pure control market. And the coefficient of the indicators represents the difference between treated and different treated arms and the control group. So we can see from this table that at the baseline, our sample firms are about 6 years old, and the majority of them are in the retail sector, with an average number of employees around 9. The annual profit was about 500,000 RMB, and the annual sales was about 3 million RMB. And regarding managerial characteristics, almost 60% of the managers are male, and about 25% of them have college level education. At the baseline, only 25% of our sample firms say that they have received a loan from a formal bank before, but most of them still say it's very difficult to get loans from formal sources because it normally requires collateral or guarantors from the government. And we have attrition rate of about 11% from baseline to endline survey. And there's also an additional 30% firms got closed down during this sample period. But we can see from the table that most of the variables are balanced between different treatment arms. Okay, so first let's look at the impact of our intervention on borrowing outcomes. So this figure shows the borrowing results by the end line, and we can see that treated firms are about 31.5% percentage points more likely to borrow, and this indicates a big treatment effect. And then when we compare the control firms in the pure control market versus control firms in the treated market, we see that if you have some peer firms got treated, even if you yourself did not receive the information, you are about 17.8 percentage points more likely to get the loan compared with firms in pure control markets where nobody got treated. So this might suggest that there can be information diffusion from treated firms to control firms among the treated market. And we can see the effects in this regression table, where we see that here only about 3% firms in the pure control markets got the loan by the endline survey, but for untreated firms in the treated markets, they are much more likely to receive the loan. And in columns 4 and 5, we also look at the impact on borrowing from other sources, but we did not see any negative impacts. So this provides some suggestive evidence that those firms are credit constrained, and this new credit product does not crowd out their existing loans. Okay, so before we move on to the estimation results, let me show you some big picture data pattern in which we plot the density, the distribution of log sales at baseline and follow-up survey. So this figure shows you the distribution of log sales for different groups at the baseline, and we can see that they are very similar. And then 3 years later, we see that the red curve, which plots the sales of treated firms, moved to the right, and this suggests a positive direct effect. And also, interestingly, the red line, which shows you the distribution of untreated firms in treated market, moved to the left of the green line, which is untreated firms in control markets. And this could suggest some negative indirect effects. So to guide our estimation here, let me just quickly present our theoretical framework. So it's basically a Malay-style model with nested CES, in which monopolistically competitive firms are organized in local markets. So goods purchased in a market can be aggregated to accommodate good QM, and consumers have preferences over different goods in different markets. So here, HI indicates the product quality, and sigma is the within across markets elasticity of substitution, and theta is the within market elasticity of substitution. So we assume that goods are more substitutable within than across markets, which is consistent with the situation of our sample firms. And we further assume that firms produced with labor have constant return to scale and differ in productivity. Then imagine there's a treatment which can increase the quality adjusted productivity by a factor of gamma, which was randomly provided to a share SM of firms in a market M. Then to a first order approximation, we can write the impact of this treatment on firm revenue in the following way. So there are two components here. The first component indicates a positive direct effect. And the intuition is that the long-induced improvements in quality and productivity. And this allows firms to reduce their quality-adjusted prices and therefore would attract a higher demand. So the coefficient, the magnitude of this direct effect is proportional to gamma, which measures the decrease in the quality-adjusted prices, and also proportional to sigma -1, which is the elasticity of from revenue to price. And the second term is the negative indirect effect from competitors. So the higher the share of competitors who borrow, the lower the quality adjusted price index in the market, representing the strength of competition, and the lower the demand for the product of the firm. So this coefficient is proportional to gamma because the larger borrower's average revenue, the higher their absolute impact on the price index. It's also proportional to sigma minus theta, which is the elasticity of firm revenue to the market level price index. So with this, then we estimate our intervention effects using the following specification. So in this regression, on the left hand, YI indicates firm outcomes such as sales, profit, employment, etc. And then on the right hand side, treatment is an indicator for whether a firm received a treatment. The share of competitors treated is defined by the share of firms located in the same market and selling the same products that got treated. And we also control for firm fixed effects, and we cluster standard errors by the market. So here, beta represents the direct effect of the treatment, and delta measures the indirect effects of competitors' treatment. So in this table, we present the impact on some main indicators of performance. So here we can see from, so for example, column 1, that the treatment did substantially improve firm sales growth. But at the same time, there seems to be a big indirect effect, which is negative from your competitors that got treated. And the magnitude of the coefficient indicate that if all of your competitors in the market got treated, then it can reduce your sales growth by about 8.6%, which almost offset the positive direct effect of borrowing. And we see similar pattern of impacts on other outcomes, such as profits, employment, and wages and material cost. And the last column shows that treated firms are less likely to be closed down, but there's no indirect effect on shutdown. So overall, this table suggests that there's a large direct effect of borrowing, but also a big indirect effect from competitors. So then in the next two slides, we report the impact on some intermediate outcomes and suggest the mechanisms of the finding. So in this table, we look at the impact on number of clients and several types of measures of quality and cost. So firstly, column 1 shows that treated firms seems to attract more clients, but similar as what we see in the previous table, there's also a big negative indirect effect from competitors. So this suggests that there's a reallocation of clients to the treated firms, but there also seems to be business stealing effect from firms' competitor. Then in columns 2 to 4, we look at the impact on some quality measures, and we see that treated firms are more likely to renovate their stores. They're also more likely to introduce new products to improve product diversification. And also the quality of labor also improved. So this is proxied by the share of their employees that have at least a high school level of education. Then in the next 3 columns, we look at some cost measures. So firstly, if a firm got treated, they're more likely to switch to a new supplier. They're also likely to increase the stocking period, meaning that they're buying inventory less frequently, but each time they would purchase a larger bundle, and this could normally give them a higher discount. They're also more likely to do inventory management, meaning that they have electronic records of inventories and also have a designated area to store their inventory. And we also note that for those quality and cost outcomes, we don't see much impact, a big indirect effect as before. So this suggests that there could be net gains on the market level for those dimensions. In the next table, we look at the impact on prices and consumer evaluation. So column 1 suggests that there's a negative impact on price, meaning that the traded firms actually managed to reduce their prices. And this could be driven by the fact that there's cost reduction because of supplier switching, the increase in the stocking period and the discounts they receive from the new supplier, and also the fact that they do inventory management. And also, according to the consumer satisfaction survey, there seems to be improved consumer experience among the traded firms. So this suggests one potential mechanism of the effect, which is firms tend to use the loan to make investments and improve the quality to price ratio, and this led to the reallocation of demand. So this indirect effect could also vary by the location of the firm. So here we use the location data that we collected in 2020, and we look at whether firms got, whether the indirect effect varies by the firm's location in the market. So specifically, we define local firms by local firms by the 4 or 5 nearest firms, neighbors to a firm. So, and then we categorize peer firms into local competitors, local non-competitors, non-local competitors, and non-local non-competitors. And then we re-estimate the information diffusion effect separately for the treated and the control group. So we see that there's no information diffusion effect for the treated, mainly because they already received the treatment themselves. The among untreated, we see that most of the information diffusion comes from the local non-competitors and non-local competitors. So why do they learn about the loan from local non-competitors? This could be they are not directly competing with each other, but they are very close in the market, so that they are sharing the information with each other. But then why could they receive information on non-local competitors? So this could be because they are not so directly competing with each other, but firms that are selling the same products could have access to some or care about similar types of information. So there might be a benefit of repeated interaction, like I share information with you today, then I expect you to also share information with me. So this means information diffusion seems to come from similar firms who are not direct competitors. And given this result, we then estimate the indirect effect from non-competitors in this table. So in columns 1, 2, 3, we just redo the main estimation, but adding the indirect effect estimation from non-competitors, and we actually see a big and a positive indirect effect from non-competitors. So the more that your non-competitors got treated in a market, then it could generate some positive impacts on your business performance. And there could be 2 reasons for this. And the first reason could be, as we see in the previous table, there's information diffusion from local non-competitors. So maybe this is because you learned from local non-competitors about loan, and you're more likely to borrow, and the loan improved your outcome. But another possibility is a demand diffusion effect, in that if a consumer visits one market, they if your neighbor managed to attract more customers to that area, then the customer might also shop around in that area. So that also improved your store's revenue. And in order to test which story is driving this positive indirect effect from non-competitors, in columns 4 to 6, we restrict the sample to the treated firms, because there's no information diffusion effects on those firms. But even among this subsample, we still see a big and positive significant indirect effects from local non-competitors. So this suggests that this demand diffusion mechanism might be driving the positive indirect effect from non-competitors. And lastly, we also do a market level regression, in which we aggregate those outcomes to the market level. So we don't see any significant effect on sales and profits, although the magnitude of the impact is not that small. But we do see market-wide gains from survival, quality, prices, and consumer satisfaction. So far we see that there are 4 types of indirect effects, including information diffusion about the long product, a negative business ceiling effect from competitors, a positive consumer gains, and also demand diffusion from non-competitors. And the main mechanism of the effect is that the long enabled firms to make improvements in quality to price ratio, generating positive consumer gains and reallocating demand. And the impact was concentrated on consumer rather than producer surplus. So in the last part, we do a welfare evaluation. So in this part, we bring back the positive information diffusion effect, which was ignored in the previous empirical estimation. And specifically, we estimate this IV regression, in which we regress outcomes on firms borrowing and share of competitors borrow, but we instrument those 2 variables using our randomized intervention. And here we ignore the demand diffusion from non-competitors, but incorporating them does not have big impacts on our results. So we see the IV estimation results from this table, which is largely in line with the reduced form estimation. Then we use this to estimate both the consumer surplus and the producer surplus. So our model predicts that the consumer surplus is basically reflects the reallocation normalized by the elasticity of substitution, or in other words, it measures cost saving from reduction in the quality adjusted prices. So for a given elasticity of substitution here, we can estimate the consumer gain from our estimates. And again, in producer surplus is defined as a net increase in profits in the market. So using our estimates, we can estimate the producer and consumer surplus, and we consider 2 scenarios here. One is to treat all firms in the market, and the other is to treat 50% firms in the market. So we can see that in either case, the producer surplus is very small, mainly driven by the fact that there's although there's a big direct effect, but there's also a huge negative business ceiling effect from competitors. But we do see a big gain in consumer surplus. So the intuition is that the direct effect of the treatment is big, meaning that consumers did value the improved services or prices resulting from the treatment. And lastly, we estimate the return to capital, and we separately estimate the private return and the social return. So the private return is estimated to be about 74.2%, which is kind of between the some of the existing estimates, where Banerjee and Duflo 2014 estimated 105% and Demel et al. 6%. So our estimate is between those 2 measures. And then when estimating the social return, we deduct the private, the business ceiling effects, but then add back the consumer surplus. And we estimated a social return of about 60%. And this is largely driven by the consumer gains. So to conclude, in this paper, we examined the impact of access to credit on small and medium enterprises. And we find that there's a large positive direct effect, mainly driven by a lower price and higher product quality. And more importantly, we also find 4 types of indirect effects, including a positive information diffusion to similar non-rival firms, a negative business stealing effect from competitors, a positive price-adjusted quality gains to consumers, and lastly, a positive demand externality to local non-competitors. And the model-based account for both direct and indirect effects on firms and consumers implies sizable welfare gains. And this means that ignoring some of the indirect effects could be misleading in policy implications. So that's all. I look forward to your comments.
Thanks a lot. Yep, that's very interesting, very rich. Our discussant is Huanhuan, Huan from.
Thank you very much for giving me the opportunity to discuss this paper. I really enjoy reading it. Usually we find it very easy to attack someone's identification, but for this paper, I've read for so many times. Still, I find it very difficult to come up with something critical for identification. Let me just start with the summary. So this paper is document direct and indirect effects of access to finance on firm performance. So they are quite long for papers. They document the direct effects, and that's what we are more familiar with. But the indirect effects are relatively rare in the literature. And this paper come up with a very innovative design to measure indirect effects. So they created the experimental variation across markets in the share of firms having access to a new loan product. And aside from the nice RCT design, they also back up their identification and estimation with the model. So the model lays out a very nice framework to guide us through what are likely to drive the direct effects and indirect effects. And based on the model, you can also directly infer the causal identification and even the IV. So reduced form and the IV estimation come out naturally after the model. And based on this, they were able to show a causal impact of loan program on their business practice and service quality and consumer satisfaction. So this is the direct effects. They are commonly documented in the literature. What's special about this paper is the indirect effects on firm performance. So this resulted from the competition from the other firms in the same markets that receive similar treatment, or it also comes from various like stealing, business stealing effects, and improvement in in product quality, among others. So after this identification, because it's linked to the model, it's also able to provide a precise calculation of welfare gain. And this welfare estimation suggests that the loan programs improve consumer producer surplus. But it's more about the former because the producer surplus is largely offset by the indirect effects. Or it also shows that the loan program had a private return of 74%. Again, it's largely offset by the business stealing effects. And the overall social return is still as high as 60%. So despite of the negative effects, they still come up with a very high positive social return, thanks to the accounting of the indirect effects on various resources. So it highlights several contributions, and what I think is particularly important is the following two. I think it come up with a very innovative experimental design that facilitates causal identifications of not just direct but indirect effects of access to finance. And I think this is very important for policy making, who are usually concerned about the aggregate rather than the particular effects on a particular group of people who are treated. So whenever policy was introduced, it typically benefited some groups on the cost of the others. So from the social planner's perspective, it'll be more interesting to account for all possible effects, either direct or indirect effects. So this paper provides a way to identify these effects and inform policy making that could overview the overall impact from a more macro perspective. And it also complements the RCT with model-based identification and estimation. I find this part particularly impressive because it allows very natural differentiation of direct and indirect effects from various resources that were previously ignored. And it also facilitates calculation of welfare gain and return to capital that yield more important policy implications. Let me elaborate more before I proceed to some comments. So I'd like to highlight that there's very unique context for this corporate RCT. So we have come across a lot of household level RCT when it comes to evaluate the access to finance. But this paper is one of the recent RCT that are randomizing a corporate level. So it tracked 60,000 plus firms over 76 distinct markets. So this is a very impressive randomization, and a partnership with a large bank, which introduced a new loan for small, medium enterprise. And the loan product is very attractive for Chinese small, medium enterprises. We all know that small, medium enterprises have difficulty accessing finance and are traditionally credit constrained. So this provides a perfect context to evaluate the access to finance. And the corporate level RCT is relatively rare and even more rare for small and medium enterprises. And if you look into the size of loan, it's much larger, around 80,000 US dollar. So compared to the microfinance offered by existing literature, this is a very large amount of loan, especially in the context of RCT. And it's also in the context of China, which is different from the previous exercise in either Sri Lanka or the other relatively developing economies. So given that the results is very similar with the previous exercise, it also improved the external validity of this existing design. So for this part, I find the paper is very much value added simply by the research design. So for the data collection is also very comprehensive. The authors have conducted 4 rounds of experiment with 3,000 plus firms. So they have covered a wide range of variables, basically collect everything in the corporate balance sheets, and they also know like how managers various characteristics of the managers. And they also have a cross-section data on product quality and prices and consumer experience. So this further facilitates the evaluation of consumer surplus at the end of the paper. It also offers more informative evaluation of social welfare and enable this calculation of welfare based on consumer. So I find this overall design and data collection very comprehensive and impressive. And for the identification of indirect effects, they have derived the identification based on a structural model of business dealing. So basically, they are able to decompose the effects of access to finance by positive direct effect on quality and productivity. And from the negative indirect effect is mostly due to business dealing. So again, the identification based on the model, based on the structure model have facilitated the identification of various indirect effects. So we have already see the indirect effects due to information diffusion, demand diffusion, quality gain. And also because of retrieval variations, we were able to further differentiate the various sources of indirect effects further. So the model also facilitate the welfare calculation. So we not just know the welfare gain for consumer and producers, but also the whole social welfare. So this is again very important from a very aggregate point of view. So for this aspect, I think it will link microfinance evidence to macro policy implications. So I think again, I would like to emphasize the many important policy implications due to the consideration of indirect effects. So there are potentially many multiple indirect effects, which are either difficult to evaluate or simply ignored because it's just difficult to track. So even the spillover effects is difficult to estimate cleanly. But this one with the RCT in a unit context, it was able to identify these indirect effects very well. And other than these indirect effects, okay, thanks to the indirect effect estimation, the paper is also able to estimate the social welfare gain from different resources and even decomposed by producers and consumers. So this again have important policy implications, and especially for the targeted policy design. Okay, so as I emphasized earlier, I like this paper a lot, and I did try very hard to be critical, but I find it very difficult to attack the identification of the paper per se. So for my questions on experimental design, it's mostly about clarification and curiosity. And I would try to come up with some alternative interpretation of the estimation and results, and then possibly offer some suggestions on calibration of welfare gain and return to capital. So here's something I'm curious about on the experimental design. So what are the background of introducing the uncollateralized loans for SMEs? China frequently introduces industrial policy, especially by local governments, to support a particular industry. So is there a particular industry that benefit more from these loan products? So I did aware that the firms are randomized, but the markets are often concentrated on a particular industry. So a cluster of markets typically sell very similar products. And the industry seems to me very difficult to randomize. So in this case, would it be driven by the concentration on a particular industry? And also with, for the firms, right? With some firms, existing clients of the partner banks. So what I have in mind is that banks basically utilize the historical banking records to inform their decision making. So they might be more likely to grant a loan to someone they're familiar with. So in this case, because of loan application approval rate, they might be favored towards existing clients. And the firms taking that into account might not apply for a loan per se if they were, they were not previous customers of this bank. Again, it's a bit far, the logic is a bit far, but I'm curious how this existing relation, how is it likely to affect the randomization? And for the probability of borrowing, my understanding is that the small medium enterprise are very hungry for the credit. So why only 6-7% in the control group and only 34% in the treatment group borrow? So this number appears to be quite small to me. And I'm also curious about who are more likely to borrow. Are they big firms, or are they firms of a specific characteristics? And would it be still possible to utilize the existing information to tackle the potential borrowing behavior? And also think about the loan approval rate, mainly due to a low take-up by the SMEs. So SMEs not applying simply because of the low approval rate, or if the borrowing behavior is mainly driven by the supply of credit, in other words, it's mainly determined by the bank, then it actually offers a more important policy implication in the sense that policymakers who control this supply of credit can then utilize their tool to better improve the productivity. And I'm also curious about the loan officers, because I think one potential channel of diffusion might be through the loan officers. Also, the treatment intensity might vary with loan officer characteristics. And regarding the estimation, I I understand that most of the dependent variable are in log, and I also understand the profit sometimes could be negative and difficult to be in log form. But I wonder whether it could be as consistent as the other dependent variable. Let's say take the profit margin or use the gross profit instead of the RMB amount of profit. And for the fixed assets, my understanding is that it should always be positive. So why not just use the log? So it will be easier to interpret. And for this indirect effects, I believe in the story of indirect effects. I'm just not very sure that it could be just business stealing effects. Of course, business stealing effects is one very plausible interpretation, but there could be other way of there could be other channels. For example, it could due to improve productivity and then therefore increase the supply. So the increased supply lower the price and therefore lower the sales. Lower the price and therefore lower the sales. So this is through the channels of competition, might not necessarily due to one firm stealing away the customer from the other firms. It could due to just oversupply. But this could be ruled out by looking at industries with low price elasticity. Also regarding the supply and demand, and from the model, we know that long increased product quality, which is well backed up by the empirical results, and it could also increase firm productivity. So if I were to take the two sets of results from two tables, one from the demand, one from the supply and one from the demand. So the left table 4 is from the supply side regarding how much firms sell. So from this table, I know that the direct effect is that access to finance improve firm productivity, therefore increase supply, and the supply reduce the price, and because of low price, the demand increase, and therefore improve sale. So the supply and the equilibrium leads to a lower price but higher equilibrium, therefore leads to a larger log sale. That's why it can derive from the direct effects. But taken from the same tables, but based on the indirect effects, then I have the other story. So I have similar story, but results in different interpretation. So again, if my peers have access to finance as well, the productivity is going to increase even further. Supply is going to increase even more, and the price should drop even more. So in this case, I should find the peer effects on the price, but I didn't see that in this table. So there's no indirect effects on the price. So this is something I find difficult to reconcile. So why enhance competition, increase supplies, but doesn't bring down price further? So this is something that I'm not very clear about. Again, so I'm trying to come up with different interpretation of the same set of results. So for this effects on demand diffusion, could it be possible that it's due to the nonlinearity in indirect effects? In another word, the competition or the share of non-treated competitors might have nonlinear effects on various firm performance indicators. So if this is the case, right, we might observe similar results simply because the share of local non-competitors treated are larger than the others, which was shown in the results. So this could be easily settled by checking whether indirect effects vary with the scale of share competitors. Just use a simple quantile or breakdown of the share of competitors. Or we can check the distribution of 4 different measures. Is it really much higher than the others? Okay, and regarding firm and market level effects, so they're also suggesting that the 2 effects net out. But if we recall the share of competitors treated, so one set of market is having a 50% firms treated, and the other is having 80% of firms treated. So if I substitute either 80 or 50 into the share of competitors treated, the overall effect should be positive. And given that a lot of them are actually treated, and even after taking into account of the stealing effects, the overall effect should be still positive. So if I do the calculation, I would actually expect the market level outcome to be positive as well. But this is indeed not statistically significant. So I'm guessing there might be some indirect effects that are missing here. So I wonder whether this is possible. And also for the indirect effects, some of them are no longer significant once we change the model specification. So I buy the part that it might due to low power, but I'm also curious whether it's sensitive to the different model specifications. Also the indirect effects. My guessing is that if there are split overs across market, the pure control groups should be affected as well. So given the business stealing effects, firms in the pure control group should be worse off as their consumers were basically given away by all the treaty firms, even if they are in the markets. So for me, if I see that the quality in the other market is much larger, I wouldn't mind traveling to the markets that are far away. So there might be indirect effects on the control group per se. And this could be easily done by just focus on the untreated group to see whether the effects are there. Some heterogeneity tests might be useful. For example, you might want to look at the price elasticity across industry to see whether it's driven by a particular industry. And technology adoption. Some sectors are more technological advanced than the others. Would this be driving the results? Given that we see strong evidence that their treaty firms are more likely to introduce new products, improve quality while lowering prices. This seems to be very consistent with the technology advanced sectors. Okay, so welfare calculation, again, this is more about the clarification.
1 minute.
Okay, so maybe a mapping from direct and not direct effects to loan program would be useful. And some minor comments about when I first read it, I have some, I'm not quite clear about what's been stealing and what the market is referring to or what the industry equilibrium is referring to. So maybe some clarification on this would be useful. And also the variable definition, it'd be good to know what's customer satisfaction, how is it measured? Yeah, that would be pretty much it. And I really enjoyed reading the paper and good luck for publication. I look forward to reading it in AR. Okay, thanks.
Thanks so much. All right, we will have about 10 minutes left for the Q&A. Let me ask one question, which is that it seems like the market that you are talking about is like a construction, 建筑, is that right? Like 装修.
Oh, that's the market for like the photo shows, but there are other different types of markets.
Okay, so first question I was that I thought that in 装修行业, sorry for using Chinese, a lot of products are complementary, not substitutes.
Yeah.
So but your model is very much substitutes kind of a right substitution.
Yeah, you're right. So that is why we actually define competitors based on the specific type of products they are selling. It's not the case that as long as firms are in the same market, then they are defined as competitors. So for example, in the furnitures market, there can be like firms selling bedroom furnitures, and they are not considered as competitors for with firms who are selling, for example, bathroom furniture. Yeah.
But if you allow for like complementary, like in the sense that if I install this lamp, then I have to buy
Uh-huh.
that stuff, that kind of thing. Does that change
Oh,
the
yeah.
interpretation?
Right, that's interesting. So we actually did not look at the product complementarity, but maybe that's another dimension we can think about. Yeah.
Boshan and Bernie, just ask questions.
Yeah.
Boshan.
Okay. Yeah. Thanks. Thanks, Kuan. What I find interesting is that in your result, the market expansion effect is very small. So, i.e., when everyone is expanding, but the total market size remains similar. And I guess my question is like, do treaty firms, when they apply for a loan, do they know that their competitors will also get a loan, right? If they expect that everyone got loan, everyone expanded, but the market size doesn't increase much, like it's almost like a lose-lose case for every treaty firm. I'm just curious.
Yeah. So the market level effect actually is not that small. I mean, the magnitude is there, but it's just not statistically significant.
Yeah.
And I think so. This can be specific to this context because most of those markets only serve local customers. So they don't do export. They did not do e-commerce at the time when we implement the project. So that means they might be constrained by the demand, and that could explain the negative indirect effect from competitors, right? So if I manage to attract more customers, given that there's a fixed consumer pool, right? So that it will hurt their competitors. And this also speaks to like some policy implications, like whether it's good to introduce policy like this, depending on the nature of the industry. So, for example, in another very related paper by Martin Rothenberg, which looks at the indirect effect of government subsidies, he actually finds that for more tradable industries, there's not much like negative indirect effect because the firm can expand to a different consumer pool.
You're mute.
Yeah, Bernie, please.
Okay. First, I want to thank Zhang, an excellent paper, and great presentation. I also want to thank Huanhuan for a very comprehensive and insightful comment. I have 4 questions. The first one is actually raised by the discussion about how random the program is. My second question is raised by Zhiguo. The indirect effect can be both positive and negative, depending on whether the 2 companies' products are substitutes or complementary. Then also, like I wonder in this indirect effect, is there anything about, like if you're in the business school, people will think about when the market is more competitive and bigger, the consumers themselves will play a role in forcing companies to do better. So I wonder if there's an additional channel of indirect effect. Maybe you already cover it when you think about that they are substitutes. Then my third question is what exactly is the size of the program? What did the bank get? And then after this, has the bank gained more market share after the program? So this is something I'm very curious about. Then the fourth one is that if I think about what you do, it's really like random helicopter money. Because after all, it's really that the loan is like a subsidy because it busts credit constraints and so on and so forth. So it's just restricted to just SME. What if I do the same thing to consumers, to poor consumers? Or what if I do the same thing to big firms? I just give them subsidies, subsidize the loan. Something like that. So is this really more than just SME? Is it also a paper on fiscal spending? Thank you for listening.
Yeah, thank you very much for the comments. So firstly, regarding the nature of the program, I think Huanhuan also raised this question. So this is in the background of in the early, around the year 2011, 2012, because a lot of industries and especially the small firms were affected by the financial crisis. So the government wants to provide some policies to kind of help those small firms getting through the negative shocks. So the bank that we are working with, which was previously a policy bank, takes the initiative of designing novel programs to reduce the cost of lending to small firms, which we all know that is usually very costly and risky to lend to small firms. And they borrow the idea of microfinance, although this program is not a microfinance program, because microfinance, they have group lending and use some social collateral to facilitate monitoring. So in this case, because there are a lot of local markets like this in China, and also this is defined by the government. There's market office and market manager. So that is how they come up with this design, which does not require collateral, and in turn could ease the credit constraints for many firms who might not have any collateral, or they don't know anyone in the government to serve as a guarantor. But this program was not concentrated in some industry, so they did not designate certain industry to receive this policy. So, and you can see from our sample that we have a wide range of types of market which is covered by the bank. And also,
Zheng, feel free to respond to Huanhuan if you.
Yeah. So since it's all related, maybe I can also respond to some of Huanhuan's questions.
Exactly.
Yeah, and you're right that the take-up rate is not high. Even among the traded firms, only a little above 30% firms got borrowed, and this is actually very common in the experiments giving credit. You can see from the microfinance literature that take-up rate is even much lower than this. So our experiment is not designed to explain why firms do not borrow, but from talking with some of those firms, we see that many of them are still hesitating. They foresee a very complicated application process, even if the bank officer did offer to help them fill out the application forms. And I think because of the kind of not so positive interaction with formal banks, given their previous experience, many of them do not want to borrow. And there are also cases where they just don't have, some firms don't just have the desire to grow bigger. There can be some other reasons which is not captured in our conversation with them. But when we look at the loan approval rate, so I don't quite remember what exactly is loan approval rate, but actually the loan approval rate was similar between the treated and the control. So the bank is not specifically more likely to lend to applicants from the treated markets. Yeah, and we did not randomize the loan officer to across markets, and it's likely that there can be some information diffusion from the loan officer. But we did ask a question to the control firm, do you know this program? If you heard about it, where do you heard about it? And many of those consumers who said they know this program respond that they heard about it from peer firms rather than the loan officer. So that is why we claim that a majority of the information diffusion comes from the peer firms. And also regarding the size of the program, I think that's a very good question. So the bank did extend the program to more markets and more regions. And I will ask about what's their market share of lending to such types of business. But I know that a few years later, there's more and more banks entering the market. So lending to SMEs becomes more competitive since we finished the project. And lastly, for whether it would be, we will see the same results if we land to big firms. I think that's a very interesting question. And as I said, part of the reason why we see such a big indirect effect is because those firms are so close to each other, and they're serving the same customer pool. So I guess if we do the same thing for bigger firms, the impact could depend on like the nature of the industry, the degree of competitiveness, and also whether the goods sold there is tradable or non-tradable. So should I continue responding to Huanhuan's comments?
Well, you don't need to respond to everything, right? It's you can another 1 minute maybe.
Okay, so let's see. All right, so one thing Huanhuan mentioned is the non-linearity in indirect effects, which I think is very good comments, and we'll definitely check that. And lastly, about the spillover across markets. So sorry that I was not very clear about that, but actually in our context, that's not much competition across markets, because we have about 11 different districts and counties in our sample. And normally in one county, there's only one like furniture market or one building material market. And it's rare for consumers to travel across the regions or counties to purchase things. So that is why a majority of the like competition is within rather than across markets.
All right, thank you.
Can I ask one more question?
Sure.
Yeah.
Please.
I'm thinking from the policymaker's perspective. So there are two things in my mind. One, I already raised it. What's the difference between SM? What's so unique about SME in this case? My second question is that, is there a location response effect? You have so many cities, even though they're all in Jiangxi. Some cities are more advanced than other cities. So if I were the policymaker, how do I choose? Do I have to worry about the local market effect?
The local market effect, you mean the negative indirect effect?
In some cases, let's say all the firms are really not that good firms, and so on and so forth. They're all entrenched. Giving them the loan is like a freebie, and they may raise it away. In some other locations where they are where competition is very intensive, you may have a bigger positive kick in this program.
Yeah, that's a very good comment, and actually, I think that's one potentially like great question for future research regarding targeting. So I guess this is a very important question for policymakers, like how to make such credit programs more costly effective, right? So how to target the maybe the market or firms with higher growth potential. Yeah.
All right. Thanks both Huanhuan and Jing for this wonderful night for this paper. And Bernie, I think that this is next month will be this is almost the end of this year's event.
Yeah, I want to thank everyone. We are going to pause for in April and in May, because we are preparing for the ABF main conference in May, and we have an overwhelming number of submissions and so on and so forth. So the team is quite overwhelmed, and so we're going to postpone our. They have to spend time managing this, so they request and we agree that we will postpone this until after May, so that the ABF team can concentrate on preparing for the main conference. And I will continue after that. And also, I want to compliment Zhiguo. Your institute is a wonderful collaborator. They have been very helpful in managing a lot of this. I want to thank them. And we don't want to load all the mean work to them when we are busy with the thing. So that's why we decided together to postpone this a little bit. Okay, so we'll restart after the May the main conference, and so far we have been really enlightened, learn a lot from all the seminar series. I want to thank everyone for supporting this. And today I want to thank Jing for a great paper, great presentation. Huanhuan, really thank you for the discussions, and we'll ask for the PowerPoints. And Ziguo, thanks for introducing this paper to us. You are a great person in spotting important research results. Thank you.
Thank you, Bernie. Yeah, thank you everyone.
Thank you, everyone.